Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Hitesh Thakra of Newable Ventures to talk about the Newable Ventures EIS Scale Up Fund. Hello Hitesh.
Hello there, Alex.
Firstly, tell me about Newable and give me some background to yourself.
Yes, Newable's unusual in the EIS space in that it's part of a larger organisation which has been working with SMEs for the last 20 years, in fact, funded by the county councils originally. Works with 20,000 SMEs and has investments in properties and offices, capital loans and capital, but also Newable Ventures, which is the newest division for the EIS fund. The EIS fund genesis is really the LBA, which is the London Business Angel Network, which is the oldest angel network in London, and Newable bought that out a couple of years ago. And today the EIS fund is around 23 million, and it has now has had backing from the British Business Bank recently on the BBI funds. My background is in investing in innovation all my life, so I've spent about 35 years in public markets. I was a global equity fund manager in technology, life sciences. I chair the investment committee for the EIS fund. I also do other things outside of Newable. I'm on the board of the Alan Turing Institute for Artificial Intelligence. I'm a partner at a life science fund called Syncona.
Tell me, what does the Newable EIS fund aim to do for investors?
Again, slightly different from the market, we feel. It's focused really in the pre-Series A market. And as people will know that, you start off with friends and family, then a seed round, and then you move on to the pre-Series A before the Series A comes in. The gap in the market, we think, is this stage before the company gets the Series A round, which requires a lot more professional, larger investment rounds. But at the pre-Series A, the company is still developing their product, but they're more than seed. So at the pre-Series A stage, we professionalize the company to get them ready for Series A. We focus on what we call the fourth industrial revolution around technology innovation. There's a lot of convergence going on in different industries and sectors, and a lot of companies in that area are quite new with new technologies. So we'd like to help them build their business towards the Series A, and also make sure they're not just focused on the technology and they're ready for commercial.
And how many companies would an EIS investor typically have? We
do around 7 to 8 a year. We see around 1,500. The network's very broad given the history of the LBA and history of Newable and the networks they have with different regions of the country. It's a much more national EIS fund than being just focused on London. So out of the 7 and 8 per annum, we'd be investing in those over a 12-month period. Okay.
And what are the characteristics of the companies you're looking for?
We're looking at companies which have got, they're less focused on what we call consumer tech. They tend to be much more deeper technology than other companies we tend to look at. So we might be looking at software. We're looking at space technologies, so satellite companies, medical devices, AI companies, software data companies. So there'd be what they call TRL, which is a kind of technical term for what readiness of a technology. They'd be between kind of 5 to 7, so they're ready to go to prime market. But the hardest thing is the founders are quite technology centric. So we spend a lot of time with them and getting to think about how to make their product commercial for market reasons.
And can you give me some examples of recent investments you've made?
Yes, one recent investment we've just completed is a company called QLM, which is a spin out from Bristol University. People know in the past a challenge in environmental emissions has been around carbon dioxide. In fact, the bigger problem is in methane, and methane emissions are from cows and also from oil pipelines. And this company has got a piece of hardware which sits monitoring in methane emissions, and companies like Schlumberger are trying it out. We also think there'll be legislation soon to allow the monitoring to control the CH4 emissions. And we think this is the kind of company that gets starts very small and will have very large number of contracts with when these emissions monitoring becomes mandatory. So the other one I would talk about is Eagle Genomics, which is a database company focused on the microbiome. The microbiome are the bacterial cells in your gut, and lots of quite interesting science which says that the gut actually drives a lot of illnesses in the human body. And there are about 100 trillion microbiome cells, 10 times what normal cells have in the human body. And monitoring those and identifying them has been the real challenge. So Eagle Genomics is actually a software company, and they find ways of mapping the microbiome to help food companies create next generation of products to balance and manage the microbiome.
The automated data scientist is helping biologists drive breakthrough research in human genomics and microbiomics, to protect against food toxicity and contamination risk, to develop new oral health products to fight tooth decay, and to launch personal care products that maintain and promote skin health and even slow aging effects.
So companies like Cargill, Unilever are their customers, and the company has just completed a Series A. So it's a classic example of, we were involved in it in 2012, 2013, took a long time, and then eventually now they're getting large customers, and now they're onto a Series A, where typically we would not get involved anymore because we've done our bit of priming high-tech pre-Series A companies.
And do you want to talk to me about a few of the older companies you've got in your portfolio?
Yeah, so we've got, in terms of an exit, we had a company called City Pantry, which is not in the portfolio anymore. It was a company that came out of the portfolio in 2017-18. It's corporate catering. It's not quite typical what we used to do, but it was the opportunity to tackle a corporate market, and it got taken out by Just Eat after 14 months on a 1.4x exit. The other one, which is not in the portfolio either, is Astrid and Miu, which is again a consumer e-commerce company with 5 times the return for investors on that, including EIS relief.
And how long would you expect an investor typically to wait for an exit?
The rule of thumb is, we say 5 to 8 years. Now, City Pantry was unusual in 2 years. We've had, in 2015, 16, since I've got involved, we've had most of our companies go into a Series A. Nowadays, I think particularly with the US coming into the market in this country and in Europe, you can get exited out at Series B, and usually at a much higher valuation if it's US capital. So what was 8 years can be 5 years, but I think anyone investing should expect 8 years at the outset. If and when companies nothing happens to them after 8 years, we revert the shares back to the individuals, and we don't keep them in the portfolio. But that should be, our rule of thumb is that we fund companies for about 18 months runway. At the end of 18 months, we look for price discovery from third parties, and that should be enough. If they're not doing enough in 18 months, and there's something either wrong with the market or the company, and it's something we do then actively get involved in doing something, either change the product or change the management or change the company focus, because 18 months should be enough to make progress on any of these early stage companies.
And how actively do you get involved?
I sit on a couple of boards. I sit on a board of a company called New Vision, which is an ocular treatment company for eye disease and eye accidents for emergency care. It's a wound care business which is using amnion, which is kind of stem cell-like properties for healing. I sit on the board of that because it's a very exciting technology, and it allows us to manage that company's growth. We just raised £2 million on that. We have advisors from the 500 angel networks, so when there's an issue on a particular company, we can call up one of our angel advisors who will come in and often invest and then sit on the board as well. We'd like to have at least somebody from the investment committee, the executive, or our angel network at all of our companies, and I think we believe on most of them we're on there now. So it does give us gives us some advantage in watching when things are going wrong. We can get involved.
And how often do things go wrong? How many companies would you expect to fail in a portfolio?
Question. Yeah. So the rule of thumb used to be in EIS investing, you invest in 10, 8 goes to 0, one of them you get your money back, and one of them give you 10x. Fortunately, touch wood, we've done a little bit in that. Since 2015, we've had a 10% failure rate, and in the last 3 years, we've not had any. Now, some of it is because we probably do diligence probably a lot level deeper, because that kind of technology companies are high risk. So we will use our network to validate the companies. And because we like to have a longer runway, like an 18-month runway, we've got time if things are going wrong to kind of fix it and raise more money in the interim. I would say, it should be 8 times, but touch wood, we're doing a lot less. We're doing a lot better than that. There's no guarantee.
Yeah.
It's early stage, high risk technology businesses.
And are there any particular challenges you're facing at the moment?
I think we're coming out of the lockdown. I think the interesting thing is, how does the world of work change, and how does technology drive that? We've talked about companies, is Zoom a permanent feature of the world of work? It more than likely is. One of the things we've noticed a lot in our experience, we're all technology background investors, is that how long it takes for companies to have an idea for it to get adopted. So around when I was in public markets, people used to talk about Internet of Things back in 2000. And it takes between 20 to 30 years for a piece of technology to come to maturity. It's the difference between invention to innovation and commercialization of technology. And what we are seeing now is some really interesting companies in sensor technology and Internet of Things, because it's about maturity of the technology. The cost of sensors have come down. The software platforms are much more stronger now. So the ability to do this, what we call planned maintenance, is a big, big thing. So there'll be lots of questions in corporates when things eventually mature about, do we need to do maintenance in a different way? Do we attach sensors to a gas pipeline and then use sensor technology or a drone to catch all that information, instead of sending somebody out there and the overhead of doing it randomly? So the world of work will change, and I think one of the challenges for any of us in this, particularly this early stage field, is that which of the technologies is going to be the main one that wins. So it's really around, we're entering a new cycle of innovation where you get a lot of convergence. So I work a lot in digital health. So the world of medicine is going to change quite dramatically. We've seen some wonderful AI data on identifying cancer from scans, which is around 90% accurate. And probably in the next 5 years, that will probably become standard. There are blood tests which will identify 50 different types of cancers. That's already up and running. So the next 5 years in health, this convergence of health and data will generate new companies. And the challenge for us is understanding the trends in that technology, but also identifying the winning company. And actually, at the end of the day, it is about the people, the founders. Do we think the founders are the right people to take advantage of these emerging technologies? And we spend probably more time, we've probably spent more time on understanding the founders and their motivations and why they want to do it, than maybe necessarily the technology, because somebody will get the technology. We can see the trends are emerging, and these are the right people to do it.
And finally, if someone's going to invest in an EIS this year, why should they do it with you?
They would get exposure to this kind of field, area where there is a shortage of capital at the pre-Series A. It requires a particular set of skills in having experienced people. So our investment committees, 150 years of investment experience. Most people would merge seed where the company is not ready. So what we're doing is getting those companies ready for the bigger uplift from the Series A. And I think we've got the skills to be able to do that. The second, within the Newable platform, 650 employees, lots of opportunities to add value along what they offer in terms of building space, capital, etc. And then access to the angel networks who we can't know all the knowledge, but there are these expert angels who are individuals who retired or with lots of experience in the city and other industries who now want to do their own investing. we can call on these people to help us identify diligence and choose the right companies. So a much more deeper level of diligence than you might think otherwise in other funds.
Hitesh Thakrar, Newable Ventures, thank you very much.
Thank you.